Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
The Taiwanese index is just below the flat line. The Hang Seng is also absolutely flat.
Right now, today, for industrial goods, their average tariff is about 13.5%. That's going to go to zero.
So gold is trading back above $5,000 an ounce right now. Biggest one-day gain since 2008.
The closing prices are at the lows or even lower than they were at about 10 o'clock.
The volatility is just insane.
We will start seeing some order announcements happening from the global companies to India, which had probably stopped over the course of last 1 year.
120 points, 25,600. That's 140 odd points lower.
HAL has actually been knocked out of the race to develop India's 5th generation stealth fighter jet program, which is the AMCA fighter jet program.
Clients still will want to have a high-touch model and are ready to pay more than 350 rupees or 0.35%.
Well, the Nifty is continuing to hold in the green. The Sensex is trading more or less flattish. The mid-cap index is well flattish. But the big boy is coming and taking on the IT index.
And metals offset the impact. In fact, advances far outstrip declines, keeping the positive sentiment intact.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel and with me is Rima. And Rima, good to see intraday recovery on the Nifty. We're currently virtually at the high point of the day. Hopefully the IT stocks as well cut their losses. Very, very small recovery from the day's low. But that's clearly been the big drag, while the Nifty Bank has been the go-to sector because that's batting for the bulls.
Indeed, the Nifty IT index seeing its worst single-day fall since COVID, March of 2020, as it falls nearly 6.5%. But despite that, the Nifty on the whole has recovered more than 200 points from the day's low, 230 points as we speak, as it nudges towards that 25,500 marks. Mid-caps are outperforming. The mid-cap index is up nearly 0.7%, with the advanced decline ratio still having more than 2,000 stocks in the green, for less than 1,000 stocks in the red. And as Nigel pointed out, banks are batting for the bulls. But outside of that, you've got gains in oil and gas. Generally, if you pull up the Nifty CPSE index, that's holding up in the gain with a gain of close to about 2%. But let's tell our viewers what all we've lined up on the show on Closing Bell in the next 1 hour. And then we'll get chatting about individual stocks. Markets hold ground even as the rout deepens in the tech pack. The Nifty is holding closer to 25,800. Cautious range-bound trade across indices. Real economy stocks are doing well. Energy, utilities, consumer durables, metals offset the impact. Global IT services stocks sell off as Anthropic's new AI offering puts the core business of outsourcing firms at risk. That's the question mark everyone's asking. Indian IT stocks have crashed. The index has slumped 6.5%, with bellwethers like HCL Tech, Infosys, TCS under pressure. Jefferies calls it SaaS apocalypse. Hindustan Aeronautics skids following the company's exit from the race to develop India's next-gen stealth fighter jets. We'll try and understand the impact on HAL's balance sheet in just a bit. Moving on to gold, that's posted its single biggest day gain since 2008, pushing the index once again past that $5,000 mark. Rising US-Iran tensions and continuing demand for the physical metal, including from central banks, aids the rebound. Shares of Sheela Foam and Devyani International surge on the back of the Q3 numbers. Analysis coming up on the show. And later on, we'll tell you what to expect from the results of retail giant Trent.
All right, how do you position yourself in the final hour of trade? We have Rahul Sharma, Director and Head Technical and Derivatives at JM Financial Services, who joins us on the show. Hi, Rahul. Good afternoon. Good to see you in. I think, Rahul, the last time we spoke, you were sounding a little bit cautious, right, on the index. You could correct me if I'm wrong. But we've seen a big recovery from there. What's your view on the index from here on? Do you believe this is just a relief rally? Or do you think sentiment has turned, so you'll be more optimistic from here on?
Yeah, very good afternoon, Nigel. Rightly recollected, yes, we were cautious the last time we had a discussion, but things have changed overnight after the yesterday's tariff news that came, trade deal news that came. Now, what essentially we are staring at is still there is a large chunk of positions by FIs which are shorts, which have started covering in yesterday's session. We saw that number improve, the long-short ratio improving. And secondly, Nifty is sort of, changing its gears slowly but surely. And now we think the time is right. Over the next 3 odd months, we may see the Nifty do very well from here. So the multi-quarter consolidation time correction, which we were into, probably is about to end in the next 2-3 months time frame. We should see the animal spirits to be back in the market, especially in the mid-cap space and the small-cap space as well, where the damage was significant. So broad-based recovery is what we are expecting in the market. And secondly, Nifty, as far as it is concerned, a new all-time high is very much on the cards. Sooner than later, we should see that level coming up on the screens.
Sounding far more bullish today. Good to hear, Rahul. The bulls will be happy to hear that tone. What about individual stocks? What do you have for us?
Yes, so metals are the way to go. NMDC is one stock which is seen a breakout today. Very strong volumes on the daily charts. We are seeing big targets of up to 95 and 100 rupees. One can look to buy at this level. The momentum still is favoring the metal stocks in spite of the correction that we saw a few days back. Apart from that, from the heavyweights, it is Bharti Airtel. Bharti has formed a base around the 2000 mark. We feel the stock is looking good for a target of 2100 on the upside. Can be bought at these levels. The stop loss placed at 1990. So as of now, it is metals and telecom with which we are going ahead. But I think broadly, the market is showing strength today, IT being down. And in spite of that, Nifty has managed to be a plus 75%. That goes to show the change in sentiment that has happened. That is, in a good market, even negative news is getting absorbed. And probably in a day or two, even the IT space should start consolidating and rebounding.
So technically, what is the chart of the Nifty IT telling you?
Yeah, so Nifty IT index is all over the place. We saw the IT index do very well on the budget day once the announcement was there on the tax havens for the data centers. And immediately we are seeing this sector getting a big hit in today's session post what happened with the AI development that has happened. But the chart is, essentially, not giving any directional sort of, clarity. Such big distortions, they are best left on their own. Probably after a couple of weeks, the clarity should emerge. But like I said, in a good market, even the negative news gets digested and the market moves on from here. And we've seen negative news, whether even positive news as well, getting digested very soon in the market. When it was a bear market, we were seeing good news like GST and income tax rejig got adjusted very quickly. This time around, it should be the other way around, where negative news gets digested positively, and eventually the sector recovers. So wait and watch is the view on IT index, and the rest of market seems to be doing fine.
Okay, just to quickly revise the news surrounding IT. As I said, IT shares, the Nifty IT index, it's seeing its biggest single-day fall since March of 2022. That's the COVID day fall. And the reason is that Anthropic has released 11 new plugins for its Claude agentic AI. So basically, Nigel, there are LLMs and there are enterprises. And there are many companies which sit in the middle of them, including, say, a company like Fractal Analytics. What they basically do is that these middlemen, just for the sake of simplicity, they will use the intellectual prowess and the abilities of an LLM, and they will apply it to an enterprise's complex unstructured data or structured data and come up with analysis, right? They will simplify the use of many CRM tools. You want it for HR, you want to find out what the sales predictions are. They will use the LLM's tools to apply it to the enterprise data. And now the question mark is being asked on these intermediaries. Is there a risk of disintermediation? Agree that there is no case to be made for completely replacing it, right? But there is a risk that revenues get compressed, that there could be revenue deflationary, the productivity. If earlier you require 10 engineers to sit in the middle, maybe you now require 5 engineers.
Or less.
Or maybe even less, who knows, at the way in which it's progressing. I think that is the big risk people are coming down to, that what happens to the middleman, the person who is sitting between the LLM, who is the infrastructure layer provider, because those companies are getting smarter and they themselves are coming out with that middle layer, coming out with those agents who can, solve for the problem. So which is why across the board yesterday in US and Europe, you saw a sell-off. So one of Claude's updates was on legal work, where they can do compliance work, they can draft legal debriefs, they can find out risks in an NDA. And therefore, many companies which provide legal software, whether it's from Thomson Reuters, there's a company called Legal, there's RELX, Relix, there's a company, Legal Set, all of them plunged in trade. Then there were companies, SaaS companies like Salesforce, which largely provide CRM software, or a ServiceNow, which provides HR software. They plunged in trade. Your regular IT sourcing companies also were under pressure. So it's not that there's a risk to IT services companies' business model, but people are fearing that there is going to be further revenue deflation. We've already seen productivity deflation. Sentiment surrounding Indian IT companies was hit, and now it's gotten further hit. But, there is always a question mark of, was this an overreaction? And that we'll see as time plays out. But for now, there is a bit of an anthropic effect, and there is a global tech rout, and in that, Indian IT companies too are seeing red. Deven Choksi is now joining us on the show. Deven, give us your analysis and the read of the sell-off that we've seen on Indian IT companies.
Yeah, Rima, good afternoon. Well, I think probably it is justified sell-off to an extent, which has wiped off around close to $300 billion worth of market capitalization across the globe in various IT companies, given the kind of agentic AI threat that people are talking about. However, when I look at, how the Indian companies are positioning themselves, TCS, Infosys, among others, they have been systematically, adapting to agentic AI workforce in their environment to begin with. At the same time, they are converting the existing databases into a structured database, wherein probably they can access, through the agent, the solution that the companies would be requiring for the client. In fact, on the billing side also, from a pure coding kind of an outcome, they are basically moving with solution kind of an outcome. So as against software as a service in earlier days, where the services have been provided in some of the cases, now it is basically agent as a service, is being created by these kind of companies. So maybe markets have reacted a little bit in hurry as I see it, but most of the Indian companies are working in that direction with their clients. Quite possible that they may have the better ways of charging to the customer as against the time value on which they were charging to their customers. But I guess that is not taking away the larger prospect ahead. The world is requiring significantly large amount of automation to augmentation as far as their business environment is concerned. And that augmentation process is going to be really requiring some of the larger companies' role being very meaningfully played. And I guess our companies are already in that direction. So not too sure, whether one would like to sell out these kind of companies. Maybe in the current fall, they become attractive enough and go below 20 times price earning ratio in some of the cases could become a buy opportunity in fact.
Okay, the current fall may be an attractive opportunity. Price valuation multiples have corrected. And plus, these are companies with a dividend yield of 4 to 5%. In fact, since morning, we've been debating with our experts on whether the sell-off is warranted or is it overdone. We had a chat with Arvind Sanger of Geosphere Capital Management and Moshe Khatri on this issue. Listen in.
So this is not about current earnings. This is about concern about future growth, future value. And so finally, people have now started worrying about different segments and IT services, the latest ones to get this concern, because the SaaS companies are going to see, disintermediation by AI and by AI agents and by AI software. Then at some point, people are realizing that, even the software services companies are going to suffer in this same issue of can agents do the work and how much will be the value of IT services companies in that new, if that's the new world we're moving on into. And again, this may not be a one-year call, but this is a 2, 3, 4 year. There's real headwinds emerging that could be very meaningful.
Ultimately, the proof's going to be in the numbers. I just want to, factually, if you look at most companies reporting in the past few weeks, they've done better than expected. Guidance looked better than expected. So I don't know. I think we've been talking about for 2 years, the disruption has been going on. If we actually get to a better trajectory in terms of revenue growth for this space, I think that'll be, and we should be in an okay shape. The volatility is just insane. I don't know if that necessarily reflects fundamentals at this point. That's my point of view here.
All right, let's move on from the tech pack. The other stock that's getting knocked is HAL because the street believes there's an opportunity that's been missed, though their order book is still looking rock solid at close to around 2 lakh crore. Ria joins in to break it down for us. Ria?
Well, yes, HAL has been knocked out of the bidding race for India's fifth generation stealth fighter jet program, or the AMCA jet program. And HAL was expected to be the front runner for this project up until now, which is why the street is reacting so negatively to this new development. And the company had bid for the program with two other smaller firms. And this will also be the first time that HAL will not be participating in one of the country's most significant military projects. Now, the other bidders for this project include Tata Advanced Systems, Adani Defence, as well as MTAR Tech, Bharat Forge in partnership with BEML and Data Patterns, and L&T along with Bharat Electronics, among some other companies. And as per reports, 3 of these companies have been shortlisted, and the final project winner is expected to be disclosed within the next 3 months. Now, as far as the details for the AMCA project go, there's a value of 15,000 crores that has been assigned for the prototype development phase of the project, and the total project is valued at roughly 1.5 to 2 lakh crores. So this will be a very significant project. And in terms of the impact on HAL, analysts believe that this will be sentimentally negative for the company, but they don't see any material impact on the financials of the company. Remember, the closing order book for FY25 for the company was roughly 1.9 lakh crore rupees, and they are also expected to close this financial year FY26 with an order book of roughly 2.5 to 2.6 lakh crore rupees. So they also already have a very significant healthy order book that will provide them revenue visibility for the next few years. But nonetheless, the stock is taking a big hit in today's session, down roughly 6%.
Okay, all right. Thanks a lot for that, Ria. Deven still with us. Deven, what do you think? Is it a buying opportunity, this downtick that we're seeing on HAL? Or do you think the valuations are not very, very cheap? And now there is some intense competition coming in from the private names. What's your view?
Yeah, Nigel, I think they already have visibility of about 8 times their current sales book, I think, in the order book position right now. So frankly, I think from a perspective of seeing the growth in the company's business, one should not be doubting it. If this particular project has not come their way, I think because of the disqualification criteria which they have faced, which sounds like a little bit awkward, but at the same time, I think that's what I think the government wants to ensure, that no one company gets maximum business, possibly one of the reasons for which they are disqualified for this particular project. I think that puts them behind anywhere. On the contrary, I think the company remains, I think, really in a stronger bracket. Coming to valuation, I guess, I think if my number go right, I think 1 year forward, yes, somewhere around current price, I think somewhere around 28, 29 times price earning ratio, not expensive, given the kind of visibility that the stock company is offering. So frankly, the stock price fall could be, I think, a buy opportunity in a given situation.
By the way, look at Emami. The stock is zooming 6.5% on Emami. The net profit is up 14.5%. We'll wait by for the top line. But I remember Q2 particularly was a very weak quarter for the company. When the domestic volumes had declined, they were impacted on account of heavy monsoon and the GST transition. So Q2, I remember domestic volumes were down 16-17%, but the bottom line is up 14.5%, even after taking into account the wage hike impact. Revenue growth has come in at 9.7% at 1,157 crore, and it's a sharp increase compared to 9.5% on a year-on-year basis, and compared to the prior quarter, which was 800 crore, we've seen a sharp jump in the company's revenues. EBITDA margins at 33.4%. Maintained on a year-on-year basis compared to Q2 when it had dropped to 22.4%. There is a sharp increase. So the street likes it.
Yeah, absolutely. The street likes the numbers coming in from Emami. Mangalam is here. He's going to tell us about trend. But Mangalam, you want to just come in quickly with regard to Emami, just throw some color. If I remember correctly, the stock used to be 800 rupees 2 years ago. So valuations turned relatively cheaper since the stock was down 35%. But volume growth of around 9%. Would you be a little bit impressed with these numbers?
Well, these are good numbers, given the circumstances. Why do I say that? One, because Emami, nearly 60% of their revenues comes in from winter products. And this time around, we did have an extended winter delayed a strong winter as well. So a large part of their, I'm sure, skin moisturizing BoroPlus sort of range has been doing well. The company's been working a little on their men's grooming portfolio as well for a fairly long time. Their fair and handsome sort of products did not do too extremely well. So a reset out there has led to growth there too. And add to all of this, the correction in the stock from its peak, even as we speak right now, this year's 52-week high has been 655 rupees. Going into the numbers, the stock was close to around 450 rupees. So all these factors made it an attractive bet and good numbers, non-disappointing numbers, near double-digit revenue growth, near double-digit volume growth, with net profit growth of 14%, taking into account that 10 crore exceptional is something that the street likes, and perhaps which is why, given the sort of valuations at which other FMCG companies, which are reporting mid-single-digit sort of revenue growth, are trading at, the street is seeing some signs of a re-rating for Emami, and that's something that's played out for the last few quarters. But this time around, the numbers really are hitting home, and the street is respecting that.
Okay, Mangalam, thanks a lot for that. What about Trent? What do we expect from there? We have a cheat sheet, I think, over there as well.
Yes, Trent, we do have a cheat sheet. What's interesting is that Trent post its third quarter update that came by, the stock actually saw a big decline, and coming into the numbers, the stock's actually being fairly well bid. It's just the mood of the market right now. From its 52-week high, the stock is down 40%, trading at around 69 times, not particularly cheap. We know the growth rates. Standalone revenue for the company has grown at around 17%. They've opened 17 West Side stores, 48 Zudio stores during the quarter as well. And the revenue growth itself has been trending down from 19% to 17% over the last couple of quarters. But the street believes that this time around, maybe on the margin, there could be a bit of a surprise. A CNBC-TV18 poll says consolidated EBITDA growth at 19%. This at a time when the revenue is growing around 17%, which implies that there could be margin expansion. Net profit up 9%. There could be an impact of higher depreciation on account of the number of stores that they've added. Net profit will be lower because of higher depreciation. All eyes will be on management commentary around demand and revenue growth. The stock has taken a big nosedive from the peak. Any positive surprise and any indication from the management on revenue growth picking up from here could bring back believers of Trent, which actually are sitting on a fair amount of losses all of 2025 and the start of 2026 as well.
Well put, Mangalam. When you're not expecting much, and if there is a glimmer of hope, the street may latch onto a stock that was around 8,000 rupees, currently available at around 4,000. Wait by for your analysis, Mangalam. In the next hour or maybe later in this evening, it'll keep you busy, among other things. Thanks a lot for joining in. So Trent is buzzing post, ahead of its numbers. Expectations are low out there. Emami, the stock spikes up because those numbers look good. The stock has corrected close to 30% from the recent peak. So risk reward appear to be favorable and those numbers are good. And Team Lease, there's a good growth on the absolute EBITDA number of around 21%, I think is the growth out there. The net profit number has grown even more. But there is a marginal improvement in the margins. And just take a look at that. It tells you, Rima, a little bit about the market mood right now, right? I mean, barring the tech space that is worried about the global issue, any kind of good news is being digested quite well. A couple of weeks ago when you're getting good news as well, a lot of companies are not reacting to the good news. So, that's the phase of the market we've just entered, it seems. Sentiment has turned a little bit. Devin, sorry to keep you waiting for so long. Emami, Trent or Team Lease, any view on any of these three companies? Two of them have delivered numbers, Emami as well as Team Lease. And Trent, we're waiting by, but expectations are relatively lower.
Yeah, Nigel, I think Emami, good set of numbers. Comparatively, compared to the peers, I think they are available at a lower valuation. And with a higher declaration of dividend, I think it puts, more amount of confidence into the business of the company. I gather that Zandu portfolio possibly has done well for them in this quarter and has also contributed to the better margins for the company. But we'll have to wait and see the breakup for that. The trend in particular, I believe that their expansion continues, including going into the UAE market. And that could give them slightly better edge, particularly on the margin front eventually. But all said and done, everything is still in the price. Though I understand that the stock price has corrected significantly. But till at this point of time, I guess the valuations are not at all comfortable to me. Company growing in a reasonable growth phase right now and then sustaining at the same time. But the valuations are far too exceeding the kind of a growth rate assumption that the market is putting across. So in my viewpoint, we'll have to wait for, some time correction to happen along with the price correction has already happened. maybe some time correction will be justified if one wants to add further into trend.
It's been a 30-40% up move in many of the tariff-ridden sectors which have found relief, whether it's textiles, shrimp. Look at Gokuldas exports, another 20% up on that. What's the strategy here?
Well, I think the immediate reaction has to be positive, undoubtedly. Maybe I think the backlogs, which they haven't been able to execute due to the tariff-related issues, particularly in case of textiles. I think they should be in a position to clear those backlogs in a little quick succession, possibly. And that could possibly give you another 1-2 quarters of, a very high growth rate, which is also equally, a good thing if one wants to look at the numbers 1-2 quarter ahead from here. But most of the things do get reflected into the price demand, and that is where probably one need to be careful. Whether you want to ride this particular momentum at this point of time, or you would really want, the market to stabilize at a reasonable level. Maybe I would go for the second. The reasonable level stability in the performance of the company is something which one would like to expect before putting a buy recommendation on the business due to the prospects which are emerging now.
Okay, all right. Thanks a lot, Deven, for joining in and giving us that view on all of those stocks. Wishing you a good remainder of the day, Deven.
Thank you so much, Nigel.
Well, keep an eye out on a few stocks. Actually, Carousel was another set of numbers that we got earlier today, and that stock as well has spiked up. Remember, this is following up yesterday's 20% move with another 5% move. They have a high amount of exposure both to the Europe as well as to the US market. Explains why that stock has moved up. And Rain Industries, I recall we here at CNBC-TV18, roughly a month or 25 days or so ago, we were telling you that the aluminium party is going on. Rain Industries makes CPC, that's an input cost for aluminium companies. And since aluminium has got into a bull run, it seems this is one of those proxy plays. But keep in mind, the stock is moving up, but they have a very high debt in the books. So debt reduction and refinancing is going to be key to track from here on. But otherwise, that's a bit of a proxy play. If I got the number correct, I think 42% of their revenues come from the aluminium business. So that's why that stock as well is moving up. And various aluminium makers have been talking about CPC prices moving up, which is an input for them. And Rain Industries is a producer of CPC. So it could be one of the reasons the stock is moving up. But we'll slip into a short break. On the other side, Dinshaw Irani of Helios Mutual Fund is waiting for us. Stay tuned. Markets are holding up. I think the breadth of the market is particularly encouraging because the number of stocks that are moved up actually are close to around 2,100 stocks odd. By the way, another order win, Capacite Infra. It's that time of the market now where some of these order wins, some of the good news will be digested. So that's why the stock is up close to around 8.5%. As I said earlier, a couple of weeks ago, some of these bombed out names, they wouldn't be reacting to this news. But for the time being, Capacite up close to around 8%. Let's tell you what's going on in the F&O market. The Nifty Bank, as well as the Reliance Industry stock, both of them have come in there and they're batting for the bulls. And this was the call that I made earlier this morning as well, that the IT index is going to drag. So you require the big boys to come in there. They need to put their hand up and they need to do the heavy lifting. That's precisely what's happened today, because both those two, you put the Nifty Bank as well as Reliance Industries together. That's close to around 42% of the index. And you have IT index, which IT is around 11% of the Nifty. That's down by close to around 5%. So that's how it's offsetting each other. Well, the Nifty options data as well is quite interesting because the PCI that was at around 0.6, 0.62, 0.7 as well, it's moved to around 1.1. Still, it's very far away from the, overshot level, which is at around 1.6. So that's par for the course. The 25,700 put, that's seeing aggressive writing. And the premium at the start of today was around 162 rupees. That's come down to around 110 rupees. So the writers are back in the game. 25,800 put as well. Premium at the start of today was 211 rupees. That's come down to around 150 rupees. So put writing's back and the bulls will be feeling quite good looking at the screen. Now the important support levels, that's where the 20 as well as the 200 DMA is at. 25,250, 25,500. If you go by the options data, if you go by the technical levels as well, 20 and 200 DMA, that's where precisely it comes in at that. So you don't want that to break on the downside. On the upside, yesterday's high, that's 26,300, becomes a bit of a resistance mark. Individual stocks. Tech is getting slammed, and Infosys actually all through the trading sessions there not been any recovery. There is fresh shorting being seen out there, but the stock is at the low point of the day and open interest has swelled up. PG Electroplast, one of the stocks that fell off the cliff, but we had the management who reiterated that their guidance of around 300 crores in PAT will be met. For the time being, the shorts, they're scampering for cover because that stock has popped up, as is the case with KEI Industries. The stock has seen a sharp correction, but there's a short covering bounce that's playing out even on that particular name. And since we're seeing crude oil prices perk up a little bit, that explains why Oil India and ONGC are seeing fresh buy. Net, it's a good trading session till the lower levels of around 25,250 odd will get protected. Well, the bulls will feel they're very much in the game after after quite a few months of underperformance. That said, let's get back to getting market opinions. We have Dinshaw Irani, CEO, Helios Mutual Fund, who joins in. Hi, Dinshaw. Good to see you in. I was wondering whether you have changed something new with regard to the spectacles. No, it's the all one, as fashionable as ever. Good to see. Dinshaw, how are you feeling about the markets? How the sentiment has turned in a matter of around 72 hours. STT hike, everyone was disappointed. It hurt sentiment more than anything. And suddenly you have the trade deal. Suddenly you have talk about being oversold. Earnings need to pick up. As the famous Hindi dialogue said, entertainment. I think for now it is earnings need to show up. That's what's going to lead the markets higher. How are you feeling about the market now?
First of all, thank you, Nigel, for having me on your show, and a very good afternoon to you and your viewers. I thought we'll start off with our favorite call on IT sell rather than on the markets as such. Probably we'll take that up later. But the fact is that we were...
Dinshaw, let's talk about the markets later. The sell call now, do you stick by that? Do you think the fears are over-exaggerated? Is it providing some kind of a buying opportunity with the index down 7% and you have market capitalization erosion of around 11 lakh? Let's take that first.
Okay. So, Nigel, actually, you heard from Anthropic and Palantir last night, but you heard from us probably a year back, specifically February of 25 is when we called out that AI is going to be a big disruptor for IT, and we'd seen early signs at that point in time. And we still don't believe there's been a reset in that segment, because I don't think the companies are right now even gearing up for that as such. TCS to an extent has seen the writing on the wall, and that's why they've been very cautious in terms of adding manpower. In fact, they've been laying off people quite regularly. But I believe that that pyramid on which this whole structure was built, the employee pyramid, that has come under question with AI playing its part. The bottom of the pyramid, which is to control the costs for all these IT companies, the manpower costs for all these companies, all the IT companies, is going to come under question. That bottom is going to get squeezed. I mean, the bottom of the pyramid is going to get squeezed. And as a result, the cost is going to escalate upwards. And that is why that massive reset. And plus, AI is going to play havoc with the initial, I mean, the historic way that we've been doing business in India is basically the man hours into the rate per hour. The man and the hours are going to shrink because of AI. And obviously, I don't know how much rate can compensate for that shrinkage. So I think there's a reset which is happening, and we'll look at it. I don't think this it's done and dusted in IT as such. I think there's more to go in terms of not only the price correction, but in terms of even the fundamentals going off a bit.
Okay, so complete avoid IT sector for now, at least. There is more revenue deflation, which is likely to take place. Valuations could get compressed. Dinshaw, hi. What about PB Fintech? It's a stock that you've liked. Is it still a part of your portfolio? Because the street seems to be spooked by this fundraise, considering they had so much cash in the books and they're going out there and making a large acquisition.
Yeah, so it remains a part of the portfolio, but frankly, Rima, we've also been very cautious in that space, in that particular stock. We're not adding to that name in a rush. I think some kind of understanding has to come there, as in not only in terms of what the management is thinking, because they're also looking at going outside India. They want to become an MNC. I think these all things are, with India giving you such a huge growth option, I don't know why that looking at outside markets for growth. So maybe we'll have to do a rethink out there and see what it goes. But anyway, we're not adding to that position as of now.
Are you considering selling your holding?
No. And even if I was going to tell you that. But no, as of now, no.
Did you chat with the management and raise the concerns? I mean, I'm sure it's been flagged off by many people in the market. They can see it in the stock price. But have you had any conversation with PB Fintech?
I'm sure my analysts would have had conversations with them. I haven't directly had a chat with them.
Okay, all right. Dinshaw, anything else? Since we've got the US trade deal done, chemicals, textiles, those stocks are flaring up. You think it's time to look at it?
So fortunately for us, we had Gokuldas Exports with us, which is a part of our holding. It's a disclosed holding, so I can share that name. And obviously, we had KPR Mills. These were the two stocks in textiles that we held, and that has done phenomenally well. But one more thing out here, Nigel, is that despite the tariffs, if you had seen Gokuldas results, which came last week, they did fairly well in terms of margins. We were of the opinion that the margins will shrink quite drastically, but they did very well. And what argument the management gave on the call was that even the US buyers are right now having a paucity of suppliers. So they are looking at India in a very benign way. And as a result, we have to let go of some margins. But can you imagine with now tariffs coming down 15 to 18 for textiles, this is going to be a big boost for all the profitability. In fact, the margins will come back. And I'm sure there's at least FY27 will look a very exciting month, not only for textile companies, but other plays also like auto ancillaries, which saw a lot of compression last year as such. So that way.
So in the earnings season so far, Dinshaw, what is it that you've liked where you are seeing a big potential basis the numbers, the strategy, the commentary that you've added on recently to your portfolio?
So actually, we've basically the quarterly numbers didn't, we haven't changed our portfolio based on the quarterly numbers because we take a slightly longer term view as such. But what we did have noticed in this quarter specifically, and this is a replica of what happened in the September quarter also, that the small cap universe has done far better than the mid cap and the large cap. So basically, small cap has done better than mid caps, and mid caps, I'm talking about earnings growth, has done better than large caps. So if you look at the NSE 500, some 250 odd stocks declared the numbers till the end of Jan, and of which I think the large caps were some 54, 55 odd stocks. The growth there was just 2%. For that, and effectively for the small cap, which was around 120 stocks, which had declared the numbers, the growth rate was north of 40%. So obviously, this is where the excitement lies for us today. And mid caps are around 19 odd % growth. I think some 70 odd stocks has declared the numbers out there. So that way, I think this is what is making us look at the small cap and the mid cap universe more appreciably now.
So you're quite constructive on the markets, it seems, at this juncture. Would that be fair?
Yes, definitely, Nigel. In fact, the worst seems to be over. One saw that in the last year. and with the kind of fiscal loosening that the government has been undertaking and the RBI also on their part has been undertaking, I think that has helped demand come back in a big way. One saw it in the September quarter. One is seeing that effectively even in the December quarter. And I have no doubt, hearing the commentary of various managements after the results, that this particular quarter, the March quarter, also looks fairly exciting. So I think the worst is over. From here on, you'll see growth, tariff coming back to normalized levels. I think there's no way FIs won't come back to India.
Let's party soon. Thanks a lot for joining in, Dinsha, and giving us that comment. And good to end a conversation on an optimistic note. See you soon.
Thank you.
Let's hop across to Hormuz. He joins us to tell us all the big movers at this hour. Hormuz, take it away.
Well, if you try to look for a gainer on the IT space, you would find an error 404 on this as of now, because that's the kind of fall that you have seen in a lot of these companies, be it Infosys, TCS, Persistent, Coforge, all of them. For TCS, it's the biggest drop since March of 2020. And since for others as well, it's a multi-year drop for a lot of these companies. Now, if you take a look at the market cap lost as well, Infosys at the lowest point of the day lost close to 60,000 crore. TCS lost close to 80,000 crore. TCS, HCL Tech, Wipro, Tech Mahindra, all of those are almost $1.5 lakh, even more than that, 1.5 lakh crore and more wiped out in a lot of these IT companies. Now, the recovery from the April lows was pretty evident from these names. Most of these stocks made a low on the 7th of April when Donald Trump announced a tariff pause first up, and then they have recovered anywhere between 10% to 30% on the large cap space. Persistent and Coforge, of course, they have been outperformers, so they recovered a lot more compared to their large cap peers. Now, what have the mutual funds done in this period between March and December? They've continued to hold on, or more than increase their stake in a lot of these companies, be it Infosys, be it TCS. They're of course closely held companies as well, but look at Persistent and look at Coforge. Mutual funds have increased their stake during this 9-month period. Same is the story for the retail investors as well. They too have mostly increased their stake, barring of course Persistent Systems, which has seen a slight trimming, and HCL Tech, which has seen a slight trimming, and Infosys too. But most of the others, the shareholding has either remained stable or it has increased compared to where it was in March of last year. But the story doesn't end, because despite this fall and the recovery that you had seen before today's accident, most of these stocks are still well below their peak, which was either made in December of last year or in January of this year. Most of these names down anywhere between 10% to as much as 35% for stocks like TCS.
When numbers can paint a picture. Thank you very much, Hormuz, for that. Get into a break. On the other side, we'll get you a check what dealing rooms are saying in D Street Chatter. Stay tuned.
Welcome back. Markets holding in the green. Good time to go across to Nimesh and D Street Chatter. Nimesh, now thumping has started?
Not really.
Not really. They're happier at least.
I'll tell you other way around. Nigel, there is still a lot of disbelief in this market because still I'm getting a lot of feedback and a lot of queries that is this a good deal? Are there any devils in the details and all? So clearly, the position is so light and the markets have rallied in the last 2-3 days that everybody's missed out. So there is still a bit of skepticism, and that's why people are still looking for negative news. Or for that matter, not able to participate because it came as a bit of a surprise for many, and they've lost out. So that's the feedback. From a today's market perspective, I don't think it's a bad outcome, Nigel. Given the fact that the Nifty index, the IT index is down 6%, that's dragging the Nifty by almost 150 points, and still the Nifty up 60-odd points. So clearly there is momentum after the US-India trade deal, and that momentum is continuing in today's market as well. The good part is now we are seeing a bit of momentum in the broader markets as well. The small cap index is up nearly 1.8%. There is a lot of momentum in the broader market names, and looks like that catch-up rally is only going to continue in the very near term. We've seen a bit of Nifty rally of 1,000 points. Now it's spilling out to the broader markets as well. In today's flows, well, it's mixed, but I understand there is a bit of buying back in the select PSU names as well. So the PSUs are firing. The mid-cap index is done. Small cap index is buzzing as well in today's market. So clearly the momentum is back, but I'll still say that there is lack of interest and participation from retail and HN investors. Clearly that's showing up from the interaction that I'm having. Again, technically, the next level to watch would be another 400 points on the Nifty to watch out for. But it looks like the Nifty move is done. I guess now the big momentum might happen, but at least from the very near term in broader market names, both in the mid cap as well as in the small cap.
Indeed, Nimesh, maybe you got oversold on the downside. Some glimmer of positive news, and positioning was rather light as well. So let's hope that we can continue this good run. But widening of the market, I agree. Broadening of the market is going to be important. Individual stocks, though, what are you picking up?
So a couple of names in the broader markets. The first stock is Kryzac. That stock is under pressure today. It's been consolidating in a narrow range, but under pressure today because there is anticipation and indication of a large block deal coming very soon. One of the promoter entity could be a potential seller, and I understand some domestic mutual funds are likely to bid in that block. So watch out for a large block in Kryzac very soon. That's the first name. The second stock is Mahindra & Mahindra. That's been buzzing in trade today on very strong volumes. Remember, the company announced a very large export order, and also I understand one long-only fund has been aggressively buying in M&M in today's market. So watch out for M&M in terms of delivery data. The third name is HCL Tech. It's part of my list today simply because, well, the entire IT pack is under pressure. I understand there is a small MOC buying in HCL Tech. Among all the IT names, this is the only stock where there is a small MOC buying. So watch out for HCL Tech there. And the last one is BLS International. Again, part of the broader market momentum back. BLS International is buzzing in trade today. It's up 12%, large volumes as well. The results are on 6th, but I understand along with the results, there could be potential corporate development as well. The street is anticipating maybe there could be a buyback announcement. So that's the reason why BLS International is buzzing in trade today.
Thanks a lot for that, Nimesh. Interesting times, with regard to the markets, and plenty of news flow as well. But let's focus on the money markets. The rupee did not follow through on the 1% move that we saw yesterday. It's remaining range bound at around 90 to 90.5 paise or thereabouts. Lata joins in to help us out with a quick analysis on what's going on. Lata, what are you picking up?
Yes, it's a tight range that we have seen, the dollar moving between 90.25 rupees to $1 and 90.5. That limited range. The pressure on the rupee came actually from a lot of dollars which PSU banks bought early morning. So the guess is this is probably for some government payment. It could be defense payments or interest payments which the government is making. But the bigger sentiment negative was this Anthropic news. After all, a large chunk of India's exports comes from services exports, IT services exports. And if that will be under a cloud, that tended to be a bit of a negative for the rupee bulls. The important part is that people are not very impressed in the rupee market about this 4,236 crores of rupees, is it, of FPI buying that we heard on Tuesday. That was the final number. The custodial banks tell us that they don't see that kind of excitement among their clients. This could be just short covering or hedge funds buying. The real FPI buying is not the buzz they got. On the positive side, they said there is no role that Reserve Bank played. Reserve Bank did not buy or sell dollars. So the anxiety of the market that if the rupee appreciated too much, the Reserve Bank may come and, buy dollars. That kind of a sentiment also was not there. But clearly, the huge recovery that we saw in the rupee on Monday and Tuesday, that spirit is not there on Wednesday.
Thank you very much for that, Lata. Rahul Sharma is back with us for a few BTST calls. Rahul?
Yeah, so one stock that I'm liking on the banking space is Axis Bank. The stock has corrected to its support area of 1335, 1340. One can look to buy at these levels with the stock placed at 1310, and we are anticipating a target of 1380. 1390 in the by tomorrow, maybe day after tomorrow. Another stock which is closing very strongly is NMDC. Very strong volumes on the cash and derivative segment, closing above the resistance area of 85. We feel that this stock can move up to 87, 87.5 in a day's time frame, and one can look to buy for the BTST with a stop placed at 84.90.
Got it. Okay, all right. Thanks a lot for that, Rahul. We look forward to chatting up with you soon. For the time being, slip into a short break. Mayuresh Joshi is waiting for us to help us out with some stock talk.
Welcome back. We were almost at the 25,800 mark, so retraced a bit in the last 45 minutes. So now down to levels of 25,750, but still managing a close in the green with the mid-caps outperforming. Eternal is a stock to watch ahead of its numbers, going strong with a gain of nearly 5%. Mayuresh Joshi is now joining in from MarketSmith India. Trent is the one I was referring to because its numbers are expected. Mayuresh, the street has been disappointed with Trent's numbers for a while now as valuations keep getting derated as we get set to a new normalized growth rate aligned with its size. What is your view on Trent now and expectations?
I think, afternoon, Rima, I think the expectation largely is going to be a mixed bag as far as Trent is concerned, looking at what their update has probably come out. But anything which surprises the street, I think the street and the mood and the sentiment that the market is now in I think it will be taken positively with both hands. And therefore, any positive surprise on same-sale store growth in terms of commentary related to Zudio, in terms of store expansions, in terms of the product mix, I think that is going to do the trick. So I think any number which is probably a tad bit better than street estimates is something that is going to probably ensure that the stock reacts very, very positively. From a MSI standpoint, I think the rating ranking seems to be on a neutral ground, and therefore I think we'll wait for numbers to probably come through and then probably take a call.
Okay, all right. Mayuresh, I want to ask you about two metal companies, but let me just run you through the news first. Lloyds Metal, the stock is buzzing in trade. The Q3 numbers were very, very good. Margins at around 35%, and the EBITDA number came in at around 1,800 crores. Keep in mind, 1,800 crores is more than what they were doing on an annual basis just two years ago. And if you compare it with the FY25 EBITDA number as well, 1,800 crores is nearly around 90%. So clearly, those numbers are very, very good. The guidance has been very, very hefty, with regard to the iron ore sales volumes, whether it's the pellet sales volumes, and even DRI. Keep in mind, in FY27, they'll actually become a steel player. So there'll be maybe 150 to around 200,000 tons of steel that they'll be selling. We spoke to the management earlier today, and I quizzed them whether or not, they can do around 7,500 crores of EBITDA on only their iron ore as well as their pellets business. And they said that, maybe the numbers are not very, very off. Triveni Earth Movers, the management said, Mr. Gupta said that the EBITDA can move towards 2,800 to around 3,000 crores, while the copper business can generate 500 to around 700 crores. So now the market capitalization of Lloyds Metal is more than 65,000 crores with an EBITDA ballpark 4 to 5,000 crores. However, going by this guidance that they've given, it appears that the EBITDA number can actually be 10 to around 11,000 crores, which then makes the stock available at the top. That one popped up in trade. NMDC, well, Nuvama, they came out with the no. They maintain a hold rating, by the way, but they've increased their target price around 85 rupees from around 79 rupees earlier. Their view is basically that they are forecasting the iron ore prices to move up by around 400 to around 500 rupees in this month itself, because steel pricing has moved up. And they're saying that because of the iron ore price hikes that are likely, that's what's going to drive the EBITDA number for Q4, and it's going to look quite good. So because you're bracing for a good push in terms of prices as well as volumes, they're raising their EBITDA estimates by around 5 to around 10% for the next couple of years. Even the volume estimates, actually, they're going in higher. So on the back of that, after seeing a bit of a correction yesterday, that stock is well up close to around 5%. Mayuresh, you like either of the two? Actually, I think in the past you've spoken about Welspun Corp as well. So any of these names, Lloyd Metal, NMDC, or Welspun Corp?
Afternoon, Nigel. So I think the stellar show from Lloyd Metals continues. And as you rightly pointed out, I think the expectations in terms of an FY27 number as far as Lloyd Metals is concerned, I think probably looks far stellar. Iron ore production expected in the 25 to 26 million ton range. The pellet production with the tie-up that they're probably expecting to do with Tata Steel as well, between 6 to 8 million tons. The DRI production line is up. The slurry pipeline is probably aiding a large part of the sponge iron volume sales as well. And steel production should probably edge around that 0.15 to 0.20 mark. Therefore, I think looking at numbers and how margins have now been laid out, with more synergies coming through, and the addition of the copper business, I think the acquisition that they've probably done with a 12,000 TPA at this juncture, expanding that to 30,000 TPA for the next few quarters, iron ore volumes expected to inch higher. The EBITDA that has been reported for 9 months for iron ore volumes or iron ore in general has been stellar. The pellet EBITDA per ton has been reasonably good as well. So to that extent, I think stellar set of numbers from Lloyd Metals. The momentum can very well continue. As far as NMDC is concerned, I think the downstream business is something to be watched out for. And therefore, I think expectations in terms of ferrous players as a pack, in our opinion at Market Smith, as a sectoral perspective, I think the rating rankings look pretty robust as we speak. So I think base metals, huge rally done. I think the second leg of the rally will probably move to the ferrous counters. And therefore, on the downstream part of the business, as far as NMDC and the steel operations are concerned, I think that can continue doing well, because in our opinion, I think ferrous players, with the safeguard duties that have come through, both revenue growth as well expectations in terms of utilization levels going higher, might mean better operating leverage and better reported EBITDA per ton. So yeah, watch out for both these stocks, NMDC and
Thanks a lot, Mayuresh, for joining in and giving us that quick view. We run out of time on this edition of Closing Bell, so we'll just need to wrap down the markets actually. What lost out today? The tech names. Market capitalization erosion of more than 10 lakh crore. Infosys, TCS, HCL Tech, all the top losers actually, the top 5 losers on the Nifty. were all from the tech space. Then what bailed out the bulls? Well, you had Trent and Eternal. Both of them have corrected a goodish bit from the top. They came in there. They tried to do some kind of fight back. But the real heavy lifters had to be Reliance Industries. That was up more than 1%, and it's closer to 9% weightage on the index. So that did well.